In this episode of the FXTM educational series, we're going to be taking a look at the concept of trend. The old trader adage of the trend is your friend is really critical. It's very difficult for us to overstate how important that is. And although it seems fairly simple on the surface, there is some complexity sometimes and some subjectivity in identifying what really is an uptrend or what really is a downtrend versus a channel. Now, we can apply some rules, and we should. The rules that I'm going to be applying in this video are developed from concepts that were initially introduced by Charles Dow. So we're going back to some of the core components of technical analysis and technical theory. The idea is fairly simple on the surface, and that is to basically identify a positive trend. As you can see here, I've drafted a couple of idealized examples here on the board. So we'll say that a trend has recently emerged, but an investor needs to be able to really identify it. And what we're looking for are two successive higher bottoms with two successive higher tops. Once we get that trend emerging, so this trend of higher tops and higher bottoms, we can then identify this as a positive trend. Now that does mean that identifying a trend, especially after a trend change, may lag a little bit, that initial price movement, but it helps us to identify when the trend is going one direction or the other so that investors can prioritize bullish entries, for example, in a positive trend, or bearish entries in a negative trend. Now, a negative trend is very similar in the sense that if we assume that the price here on my idealized example has been declining just recently, what we're looking for, again, are successive falling tops with successive falling bottoms. So once we've seen two falling tops and two falling bottoms, we can then say we have defined a downtrend. Now again, there is going to be a little bit of lag here as we identify the trend in the first place, but what we're doing is we're trying to identify when is it that we'd want to evaluate bearish entries, or for longer term bullish traders, where is their risk more enhanced, where is it more extreme. Now let's take a look at a couple of examples of bullish and bearish trends on two charts. Now as you can see here, we have two sequentially higher tops and higher bottoms forming on the euro to the US dollar. Now, an investor is going to evaluate this as a confirmed bullish trend, where they are emphasizing bullish trading strategies. In this charting example, you can see that we have two sequentially lower tops and lower bottoms. So that defines our downtrend in this case, where an investor would be looking for bearish entries and bearish trading strategy signals where they have the trend in their favor. One of the key concepts to reinforce here is that we assume that trends stay intact for an extended period of time. So we want to make sure that we're able to take advantage of those opportunities by identifying the trend as early as possible, but using a rule set that will allow us to be consistent. A non-trending or channeling market presents very serious challenges to investors. And you can see an example of what I mean here in my chart here. I've got an idealized example of a non-trending market where the tops and the bottoms are very uneven, so we can't really detect a consistent trend. The problem with this is that channels, while they may look attractive in the past tense, their ranges can either be so narrow that it's very difficult for an investor to make reasonable estimates about an appropriate risk to reward, even if they could identify potential support or resistance level to base their trades on. And they could be so wide and volatile that they're prone to whipsaws. So although there may be theoretically more room for an investor to be able to make some money on trading off of resistance or support such as it is within a channel, the whipsaws are so common and so dramatic that the investor has a hard time being able to navigate that and withstand the drawdowns that may occur within a channel. So it can present very serious challenges for an investor who's trying to take advantage of a trading range. In fact, to make this a little bit more clear, let's take a look at a couple of examples of both a very narrow channeling market as well as a very wide channeling market. Now, as you can see here on the dollar to the yen, the trading channel was extremely narrow. The challenge here, of course, is that the range is so tight, it's difficult for an investor to construct trade strategies that have an appropriate risk reward. Now, in this chart, we have a different problem. The range is very wide, but the support and resistance levels are also extremely unclear. The challenge here, of course, is that although there may be some theoretically larger room to move in a particular support bounce or resistance bounce, as far as they could be identified, whipsaws are very common, and it would be difficult for an investor to be able to consistently identify entry opportunities in the channel itself. Obviously, trading with the trend is going to help to put the odds in your favor. We have to remember, however, that eventually all trends do change and they start to reverse. Now, this is a topic that we've addressed in greater detail in another video in the series, and learning how to identify changes in the trend is also really important so that we make sure that we're not only trading in favor with the trend when it's intact, but that we're preparing for those changes when we see evidence that in fact a reversal is beginning to appear and we might get a new trend emerge that's opposite to the one that we were just taking advantage of.